The internet has lied to you. There are only 3 investments you need to build wealth, whether the economy is booming, crashing, or going sideways. Number 1, you need an investment that will pay you with income so you have money to pay your bills, travel the world, and do all the other stuff. Number 2, you need an investment that will give you growth so you can accelerate your wealth. And number 3, you need an investment that will protect you when we have a recession, when we have inflation, and if we see a depression. And that's why in this video, I'm going to show you how you can invest in each of these 3 investments. That way you know how to apply it to your finances. That way you can build wealth, whether the economy is going up, down, or sideways. So let's jump right in, starting with number 1. How do you invest to create that income? Because this is my favorite. You go to work or your business every day to get paid. For my male followers, I drew a mustache. In my native language Punjabi, we call it a much. For my female followers, I drew a braid. It's in my native language Punjabi, we call a gut. You go to work or your business to get paid, and now you have money. The first thing you gotta do is not spend all of that money. When you don't spend all that money, you're gonna have some extra money, and this is the money you wanna take and put away into this investment, which I'm gonna depict with this box. And the goal with this category of investments is you're gonna take this extra money, throw it here, and it's gonna pay you back with more money that you do not have to go to work to earn. When you go to your job, when you go to your business, you have to physically work to get paid. With these investments, you put your money here, and the money will keep paying you whether you're at work, whether you're traveling, whether you're sleeping, or doing whatever you want, because now your money is working hard to generate you more money. That's what it means to generate income from your investments. I want to show you 3 ways that you can generate this type of income, but I want to dispel any myths out there, because there's a lot of lies on the internet where people will talk about how you can get this passive income without any money, without any work, without any effort. The reality is generating this type of income or any substantial income in this way is going to take work, it's going to take time, it's going to take sacrifice, and it's going to cost money. Okay? The 3 ways that you can invest your money and generate this income passively is through stocks strategically, real estate strategically, or through your cash strategically. When I say strategically for stocks, what I mean is that certain companies on the stock market will pay out a dividend. A dividend is a cash payment deposited into your account, generally every 3 months, sometimes every month, for doing nothing except owning the right stock. Because certain companies on the stock market, like McDonald's, have these big profits at the end of the year, billions of dollars of profits, and they can do 3 things with those profits. They can take that profit and save it for an emergency. They can take the profit and reinvest it back into the company to open more stores or make better burgers. Or number 3, they can just give it away to the shareholders, people like you and me, for investing in the company, and this money gets deposited into your account. Now, the problem with investing in McDonald's is, for many people, you don't know how to actually research the company. You don't know if McDonald's is a good investment. You don't know if they're paying out a good dividend or if they're going to increase their dividend or not. And that's why for many people, investing in the individual company for the dividends isn't always very profitable, because you invest in something like McDonald's and then you find out McDonald's is getting sued, then the McDonald's stock falls, their dividend falls, and not only do you lose the income, but you also lose the value of the investment. That's why the simpler way to start is to invest in a dividend paying fund, because now you're investing in dozens or hundreds or thousands of companies that are paying out a dividend. And then if a company goes bankrupt, or if a company starts to not do so good, that fund will kick that bad company out and replace it with another company, and it's completely passive for you. I'll give you a couple examples. SCHD is an ETF, meaning this is a fund created by a company called Schwab. And pretty much any brokerage out there will allow you to invest in a fund like SCHD. As a disclaimer, I'm personally invested in SCHD, but this is a fund that invests in high dividend paying companies in the United States. So instead of you going out and finding all of these companies, you can just invest in a fund like SCHD, which at the time I'm recording this video is paying out a dividend of slightly under 4% a year. And now if a company does bad, again, SCHD will kick them out and replace it with another company. But you have a lot of options here. Example number 2 is NOBL, Noble. This ETF, again, a fund, invests only in dividend paying companies in the S&P 500 that are dividend aristocrats. What does that mean? Number 1, these are companies in the S&P 500, meaning they are part of the 500 largest companies in the stock market. Number 2, they have to pay dividends. Not every company pays a dividend, and so this is specifically dividend paying companies that are part of the S&P 500. And then number 3, they're dividend aristocrats, meaning these are companies that have paid out and increased their dividend every single year for at least the last 25 years. So the whole idea here right now is paying around a 2% annual dividend. Is when you invest into here, is investing into companies that have been consistently paying out dividends and increasing their dividends year after year after year. So you'll hopefully see more income in the future because the companies are working to grow the dividends that they're paying out. And then the third example, again, a very different one, is VYMI. This is again something that I'm personally invested in. This is a fund created by Vanguard, but this is investing in high dividend paying companies outside of the United States. So this is an international fund specified on dividend paying companies because some of these countries and companies are growing, so you have more risk for more potential return. Not only is the company working to grow, but these countries are also growing, so you could see a win-win if the country grows and the company grows, but you don't have the same stability as the United States government or the United States economy, so it comes with more potential risk. And at the time of recording this video, it's paying out a dividend of a little bit higher than 4% a year. The second way you can invest for income is by investing your money into real estate. And I want to remind you that if you are an investor or want to become an investor, I put together a full and free investing masterclass to help you on your investing journey, to show you how we at our firm look for hidden investment opportunities before these investments hit the headlines. It's a completely free masterclass. We'll walk you through how we do it and how you can start researching investments better, hopefully. If you want to watch this investing masterclass, it's completely free. All you have to do is register, and I have the link for you down in the description below. And when you register, you'll also, as a free bonus, get signed up for Market Briefs, which is my free newsletter for investors. Again, the link is for you down in the description. So 3 investments you need: one for income, one for growth, one for protection. We're talking about income right now. We've talked about how you can generate income from stocks. Now let's talk about how you can generate income from real estate. Instead of you going out and buying a house to live in for yourself, you're going to go out and buy a house, maybe an apartment building, maybe an office building, maybe a storage unit to rent out to somebody else. In exchange for somebody else living in or using your property, you're going to get paid with rent every single month. And if you do this correctly, that rent payment is going to cover your mortgage costs, your property taxes, your insurance costs, your maintenance costs, your vacancy costs, and put some money in your pocket every single month. That is the correct way to do real estate investing. I know over the last few years, a lot of people got excited by this idea of, if I just buy a property, even if I lose money on it every single month, it'll be okay because my property value will skyrocket. Well, the housing market has slowed down significantly. But when I talk about real estate investing, I'm not talking about hoping that the prices of real estate are going to go up. That's speculation. When I invest in real estate, I'm looking for cash flow. I'm looking for income. What types of returns? Well, it's going to depend on where you're investing. It's very different in New York than it is in Nebraska. So you have to understand what types of goals you have when it comes to investing in real estate. And for me, when I invest in real estate, I'm generally looking for a 7% minimum cash on cash return. Meaning if I invest $100,000 of my own money, I want $7,000 of cash flow passively after all of my expenses, $7,000 deposited into my account every single year. And hopefully it will go up year after year after year. But there's a few things I also want you to understand about real estate. Number one, when you invest in real estate, it's going to cost more money than when you invest in the stock market. You can start investing in stocks with as little as $100, I mean, even $10. With real estate, you're going to need more money. There's a lot of people that tell you, oh, you don't need money. You can just do no money down. You can do just 100% finance deals. It's so much more risk and much more likely that you're going to fail, especially if you've never done the deal before. Maybe it works for a small percentage of people, but most people are going to fail when you do that. Number two, it is going to take more work than if you're investing in stocks, because if you're actually going out and buying the property, you have to find a real estate agent, you have to find a good attorney, you have to find a good accountant, you have to find a good title insurance company, you have to find a good contractor and all their team members to actually make this happen. Not saying it's bad, but you have to understand it's going to take more work and more time. And the other now things about real estate is when you own real estate is you own a physical hard asset. You don't have that here. When you invest in stocks, you have a piece of paper that says you have ownership in this fund or in this stock. Here you actually own the bricks, the land, and the windows. With real estate, you're also in control because now if something's going wrong with the property, you can fire the property manager. You can make renovations, so you have more control. And with real estate, you also get some of the biggest and best tax breaks that our tax code has to offer. As a licensed attorney, who's not your attorney, what I can tell you is that real estate investors get to qualify for many tax breaks which allow you to make money and pay less or little money in taxes 100% legally, because that's what the tax code says. So yes, real estate is more work, but it also has a lot of wealth potential and a lot of tax protection potential, which is why wealthy people love investing in real estate. And this brings me to the third way that you can work to invest your money for income, which is through your own cash. I'm gonna go over 4 ways that you can generate income from your cash. Number 1 is to generate income by putting your money into a high yield savings account. Number 2 is a CD. Number 3 is investing your money into a treasury. Number 4 is investing your money into a treasury ETF. These 2, high yield savings accounts and CDs, are the simplest and most accessible way to park your money. I don't really like calling them investments, but let's just stick with the idea here that you're going to generate some interest on your cash. So if you have some extra cash and you have it sitting in a bank account, if you move your money into a high yield savings account, it's a bank. Make sure it's FDIC insured, and it can pay you many times more than what a regular bank will, just because it's a high yield savings account. At the time I'm recording this video, there are high yield savings accounts that are paying 4 to 4.5% a year in interest, while the average savings account is paying much less than that. A CD is a certificate of deposit where you're going to put your money into this account, but you can't touch it for a year or 5 years or longer. And in exchange, they're going to pay you with higher interest rates. I really don't like the idea of having my money locked up, but it is an option for some people if that is something that you're interested in, and most banks will offer that. Then we have treasuries and treasury ETFs. A treasury is a loan, but more specifically, it's a loan to the United States government. And every economics textbook will tell you that when you lend money to the United States government, it is the safest investment. It's risk-free because the United States government can always pay their bills. It doesn't mean they always have money to pay their bills, but they always have paid their bills. How? Because number 1, the United States government can just raise taxes to pay their bills, or the United States government can work to get more money printed to pay their bills. So yes, the value of the dollar can go down because they have to print money to pay those bills, but they've always paid those bills. So you can generate interest by lending your money to the government by putting your money into a treasury. You do that by going to Treasury Direct and lending your money to the United States government. Or an easier way to do that is by looking for a short-term treasury ETF. For example, SGOV. SGOV is a short-term treasury ETF, and if you invest your money here, you're not going to see any growth in the value of your investment. You're just investing for monthly interest payments, and at the time of recording this video, they're paying out interest of around 4.5% a year. And if you look at the value of this ETF, it doesn't change in price. The only time that the price changes is when they pay out their monthly interest payments, but the price of this ETF is not changing. That's not why people are investing in this. They're investing in here just to generate that consistent monthly income, which is around 4.5% a year. There's a couple things I want you to be aware of. Number 1, because you're investing your money into a treasury, even with SGOV, you get to qualify for no taxes on your state or local tax return when you generate money from treasuries or a treasury ETF. The other thing I want you to be aware of is it is not FDIC insured because you're not putting your money into a bank, but you're protected by the United States government. So if the United States government defaults, you're not going to get your money. But if the United States government doesn't default, you're going to get paid that interest. And finally, number 3 is you're not actually getting any growth in the value of investments. You are just working for interest, which is the whole idea here. When you invest your money through your cash, you're not seeing any growth in the value of your investment. You're just generating interest out of that investment. So the first type of investment we talked about is for income. We talked about how you can do that through stocks, through real estate, and now through cash. This brings us to investment number 2, investing your money for growth. That way you can accelerate your wealth. So you're going to your work or your business to get paid, and now you're going to take some of that extra money and you're going to put it into these investments. Investment number 1 that we talked about is for income. That way this can then pay you so you can pay your bills, travel the world, and do all the other stuff. Investment number 2 that we're going to talk about is for growth. That way you can grow the value of your wealth faster. And the reason why I say that is because when you invest your money for income, you have to think about this from a practical standpoint. If a company like McDonald's has these big profits at the end of the year and they're just giving it away to shareholders, well, that means that number 1, you have to pay taxes on that income, because anytime you generate income, you have to think about taxes. And number 2, that's money that is not being used to grow the company even faster. If McDonald's took all of the profits and reinvested it back into the company, you wouldn't have to think about taxes because there are no profits, because all the profits are being reinvested. And then number 2, if you're investing more money into the company, in theory, the value of that investment should grow faster because more money is being used to grow the value of that company. More risky because, well, you're not actually getting any profits in your hand today, but it can accelerate the value of your wealth. I'm going to talk about 2 ways that you can invest your money for growth. Number 1 is by investing your money into stocks, and number 2 is by investing your money into startups. Let's start by talking about stocks because this is the most accessible way to invest your money for growth. There are certain companies in the stock market that are trying to grow as big as possible, as fast as possible, and generally they're a little bit younger and they're just trying to get as much market share as possible. this can be a good investment because if you can get into a big company like Amazon before it's Amazon, well, then you can see a lot of upside. But a lot of companies are not going to become Amazon. Some of them will fail. So more risk for more potential return. Again, you can invest into the individual company, or you can invest into a fund that's giving you exposure to more of these growth type companies. If you want to invest into the individual company, it comes with more risk for more potential return. But for the purposes of this video, I'm going to talk about funds specifically because those have generally less risk and less work on your part. One way to do this with the least amount of risk is by investing your money into the S&P 500. This is a group of the 500 largest companies in the stock market, and now your goal is to see the stock market grow. More specifically, the 500 largest companies in the stock market grow, and you don't have to go out and individually invest into all 500 of those companies. You can invest into a fund like VOO or SPY. As a disclaimer, I'm personally invested in VOO. Both of these funds, VOO is created by Vanguard, SPY is created by SPDR, pronounced spider, and these two funds are both giving me exposure to the S&P 500. Again, nothing special here. You're just investing your money really into the broad economy, and now if the United States economy grows, the S&P 500 will probably be growing, and it's a way to get exposure to that growth without getting too niche or taking on too much risk. You're kind of just investing in the American economy. If you're okay taking on a little bit more risk, another option you can consider is something like QQQ, which will give you exposure to the NASDAQ. The NASDAQ is a group of the 100 largest companies in the stock market that are not financial, which means many of these companies in the NASDAQ are tech companies. Again, many of these tech companies are working to grow bigger, faster, because that's just kind of how the tech industry works. It's all about innovation and speed and agility. So more risk, more volatility for more potential return. A third option you can consider is something like VUG. This is an ETF created by Vanguard. This is a growth ETF that specializes in large cap companies. So again, for the purposes of this video, I'm not focusing on the higher risk growth stocks. I'm focusing on the lower risk growth stocks. This fund is focusing on the larger companies that are focused on growth. And now instead of you going out and investing in each one of those companies, this fund will give you exposure to those companies that are focused on growth. Again, you can take on more risk. There's a ton of funds out there that will give you exposure to the more startup-y, the smaller companies have the potential for much larger gains, but they also come with much more risk. So you just have to figure out where on the risk tolerance scale that you fit. For the purpose of this video, I'm not going too much into the risk side. I just want you to start thinking like an investor. The other way to invest your money for growth outside of the stock market is to invest your money into startups. Now, I love entrepreneurs. I love working with entrepreneurs, and I have invested my own money into entrepreneurs, and it is extremely risky because most startups will fail. But if you can invest your money into a startup that does grow and maybe it gets acquired by a larger company or maybe it goes public, well, now you can see the value of your investment grow by a lot. And that will hopefully make up for all of your losses. This is what Shark Tank is all about. If you've ever seen the show Shark Tank, the sharks are trying to invest in startup companies, and then they're hoping that that company will get acquired or that the company will go public. That's what it is to invest in startups. Now, back in the day, investing in startups was very difficult because you had to find the individual company and broker a deal. Nowadays, it's much simpler because there's a lot of platforms on the internet. For example, you can look at WeFunder. For example, you can look at Start Engine. For example, you can look at Republic. I'm not sponsored by any of these three companies. I'm just telling you what they are. These three companies are now in the business of helping regular investors invest into startups. Again, a lot more risk for a lot of potential return. Most of these startups will fail. Most of these companies will be a black hole for your money, but if you can invest your money into a startup that ends up growing big, well, that could be a big potential investment opportunity. But again, are you going to do that? Well, most of the times you're going to fail. But for people that have that extra money that they're interested in investing into startups, this could be an opportunity now because it's a lot easier to invest in startups than it was before. So we talked about why you need to invest your money for income, that way you can pay your bills and travel the world. Now we talked about how you can invest your money for growth, that way you can accelerate your wealth. Now let's talk about investment opportunity number 3, which is investing your money to protect you against a recession, inflation, and a depression. So you're going to work or your business every single day to get paid. Now you're taking some of that money and putting it into these investments. Some of these investments are going to pay you with income so you can have fun with this money that you're not working to earn. Some of these investments are working to grow in value, that way you can grow your net worth and grow your wealth faster. But now let's think about worst case scenarios. What about if we have a lot of inflation? What happens if we see a recession? What happens if we see a depression? How do you protect yourself? How do you protect your family? How do you protect your income? And how do you protect your wealth from that? And this is where investment opportunity number 3 for protection comes into play. I'm going to talk about 3 different ways that you can do this. Number 1 is by investing your money into physical gold. Number 2 is by looking at something like Bitcoin. And number 3 is by investing your money into foreign economies. So let's break this down one by one, starting with physical gold. So I've been investing in gold for a number of years now, and the reason why I started investing in gold isn't because of what happened during the pandemic. It's actually because in the traditional Indian culture, inflation is kind of baked into the economy. A lot of people in India may not know what inflation is, but they understand the concept because inflation has been around for a long time. And so what a lot of people will do who are not extremely wealthy is when they get extra cash, these rupees, they will convert these rupees into physical gold, because in India, gold is like real money, it's wealth. And it feels like over the last few years, a lot of people around the world have been catching on to this gold trend because gold prices have been booming. Why have they been booming? Because investors have been concerned about inflation. They're worried about the value of the dollar dropping. Investors are concerned about the economy. They've been worried about recessions. They've been worried about tariffs. And so all these things have had investors starting to look for alternatives as a way to save their hard-earned money. And we know that inflation has been happening over the last 5 years. It's been happening over the last 50 years, and it's probably not going away. So if I think in theory, if I have $10,000 of cash and $10,000 of physical gold, and I take both of these two things and I bury them in my backyard and I don't touch them for 10 years, my theory is that in 10 years, the physical gold is going to have more buying power than the cash. Why? Because if inflation happens, the value of the dollar goes down, and generally, not always, but generally, that inflation benefits the prices of physical gold. But I don't like to think of gold as an investment, because when you buy gold, it just sits there and it looks back at you. It doesn't actually produce anything of value. When I invest in a rental property, the rental property is producing value because somebody can live there and use that property. If I invest in Amazon, that Amazon stock is actually producing value because Amazon is working to sell a product. They're working to improve their profits. There's an actual value there. That gold, sure, it could be used in dentistry and jewelry, but it's not doing anything. It's just sitting there in a vault. It's sitting there in a drawer. It's not doing anything. That's why I like to think of gold as a physical form of money, a physical form of saving money, and it can be a form of protection. Again, just like anything else, investing is risky. Investing in gold is risky. You're never guaranteed to make money when you invest. In fact, you will lose money at some point, so make sure you always do your own due diligence and never blindly trust a random guy on YouTube, because I'm not a financial advisor. I'm just talking from my own education and experience here. But gold can be an option. Some people like to talk about silver and other metals. I don't like talking about them only because I don't invest in those things. I invest in physical gold, so I talk about that. There's a lot of ways to get exposure to gold. I like the idea of actually investing in the physical gold because that's the actual product. You can get exposure to gold by investing in gold ETFs. You can invest in gold mining stocks, but I like the physical asset. Then we come to number 2, Bitcoin. Now, Bitcoin is a lot more speculative, and we don't know what's going to happen with Bitcoin. Bitcoin prices go up, they go down. They've crashed, they've boomed. It hasn't proven the test of time. However, we've known that Bitcoin prices are a lot higher today than they were a few years ago, and maybe they'll continue to go up, maybe they won't. But the idea behind Bitcoin is that it is a decentralized, worldwide currency. Now, a lot of people don't use it as a currency. However, it's supposed to be a store of wealth outside of your own fiat currency. Now, full disclaimer, I started buying Bitcoin back when it was around $3,000 a coin. Yes, I sold some when it was around $70-some thousand a coin. I still own Bitcoin today, but for me, I look at it as a very speculative investment. To me, I understand that Bitcoin prices can go up and they can go down extremely fast, so I don't look at it as something that is a core piece of my portfolio. It is part of the speculative part of my portfolio, because if it was to go down to zero, it wouldn't affect me at all. That's the way I like to think about it, because to me, it is very speculative, and that's the way I price it in my portfolio. And the number 3 are investing into foreign countries and foreign economies, because if the United States were to go into a recession or even a depression, well, that doesn't necessarily mean that every country is going to end up in a recession or a depression. Now, yes, the United States economy is the world's largest economy, and if the United States economy goes down, it will impact many, if not all, countries around the world, but some countries will be impacted less more than others. And this is where you can have some diversification, some real diversification, by investing in companies or investing in countries that are not the United States. Let me give you a few examples of ETFs that give investors exposure to these foreign countries. Again, I can't tell you what to invest in. This is just to help your research. Number 1 is IEMG. This is an ETF that gives the exposure to large, middle, and small cap companies in emerging market economies. So essentially, this is investing in emerging markets, those smaller economies that are trying to become more developed, and it's investing in the small, middle, and large cap companies, all size companies there. So one way to start. Number 2 is VWO, and as a disclaimer, I'm personally invested in VWO. This is an ETF created by Vanguard, which is also giving exposure to foreign countries and foreign economies. More specifically, this is investing in broad stocks in countries like China, Brazil, Taiwan, and South Africa. And then we have EEM, again, another ETF, which is giving you exposure to large and mid-cap emerging market equities. Essentially, this means it's investing the larger companies and the middle-sized companies in these growing economies around the world. Again, more risk for more potential return. More risk because it's not a country that's the United States. It's not backed by the United States economy. It's not backed by the United States government. It's not backed by the United States military. But if these countries are growing while the company is growing, that has the potential for bigger returns in the long term. Guaranteed? No, absolutely not. In fact, this is more risky than others, but it can create potential opportunities, and it's a way to protect you against downturns in the United States. And with that now, we've talked about how you can invest your money for income, so you have money to pay your bills and travel the world. Then we talked about how you can invest your money for growth, that we can grow the value of your wealth faster. And then we talked about how you can invest your money for protection, because the reality is we will see recessions, we will see inflation, and if we see a depression, how can you protect yourself and your family when those downturns happen? And with that, you have the tools and education to understand different ways that you can invest your money. Again, if you want more resources on how do you actually find hidden investment opportunities before the crowd, I put together a free investing masterclass that will walk you through how to do that step by step. If you want to register for that, I have the link for you down in the description. Now, I know there's a lot of content on the internet about creating passive income, but 98% of what you see is garbage. If you want to have enough income coming from your investments to fund your lifestyle, it is not going to be easy. And it's not risk-free. Investing has risks, but it is possible. So now, if you're still sticking with me, let me show you how you can actually do it.